Hey everyone, in today's video, I'm going to be going through my $278,000 dividend stock portfolio. We're going to be talking about some new stocks I've been buying, some other stocks I have in my portfolio and my thoughts on them. So this should be a good video. Hopefully you stick around for the whole thing. If you like this kind of content, be sure to give this video a big thumbs up. It helps a ton with the channel, and consider subscribing to the channel as well. As you can see here, my all-time performance in this account is up about $40,000, which is up about 16.5% in all-time return here. In the last year, we're up about 7.5%, or about $20,000 in the account. So we're doing okay. My account here, and you'll see once I get into the stocks I own, pretty conservative, lots of dividend payers, developed companies as well. Lots of companies that are pretty interest rate sensitive that haven't fully bounced back. So that's why my returns are pretty modest overall, but it's a pretty defensive portfolio. So I expect it to, underperform when the market's doing well, like it has somewhat recently, but then outperform hopefully when the market is, not doing as well. So just going through some of the stocks I own here, and we'll kind of start just on some of my largest positions and filter down from there. On total value here, we have CN Rail, which is one of my biggest positions here, doing pretty well. It keeps chugging along, $172 a share. We're up 17% on that one. You can see as I just kind of go through some of these other ones, I have some big tech here like Microsoft, Google still, both doing really well, up 50 and 60%. Along with royalty payers like A&W. We'll talk about that one a little later, but this one hasn't been doing too well for me. Continuing to scroll down here, have a good mix of kind of these high yield plays that I have that pay me every month that I then reattribute to other focus areas in my portfolio, and dividend growers like Canadian utilities, bank stocks, US consumer staples like McDonald's there. Continuing to go down here into some of the new stocks I've held in this portfolio. Wyndham is one that I'll talk about as well throughout this video that I'm starting to build a position in. Dream Industrial is one I've been buying recently as well. Given how small it is, that's one that I'd be looking to make into a bigger part of the portfolio. And then the S&P 500 as well is one that I've started nibbling into, and I hope to, nibble into consistently over the long term. So going to go into a couple stocks here. The first one I wanted to talk about is Wyndham. Wyndham here, $70, $71 stock. Looking at this stock in the last year, up about 5%, give or take. Last 5 years, up 27%. So paying 5.5% in capital returns at least a year. You also get a nice little 2% dividend. So about 7% annualized return over the last number of years. But one of the great things about Wyndham that we'll talk about is they buy back tons of shares. So their actual market value of about $5 to $6 billion has been pretty consistent over the years here. And I just want to talk a bit more about this company. So I'll just start off with showing how Wyndham is much more than just the Wyndham brand. You got lots of other brands that you may have not known are affiliated or owned by Wyndham here, like Ramada, Super 8, Days Inn. They've recently made some acquisitions in the more upscale and upper upscale space, but La Quinta is a big brand for them as well. So they own all of these brands on the page, but they don't actually own the physical hotels. They are a franchisor. So franchisees, some of these are small business owners who own one or two of these hotels. Some of them are conglomerates who own dozens or hundreds of them in a certain region. But they actually own the day-to-day operation. Wyndham just gets a licensing fee and a royalty on the daily room rate that they charge the end consumer. So it's a really cash flow heavy business, not a lot of capex that has to go on their operation side of the business. The one thing I'll warn or just call out is it really looks like through this picture that they're well diversified across economy all the way to upscale. A big part of their business, if you actually look into their performance and where they're deriving their revenue from, is really in this economy and somewhat mid-scale space. They have tons of Super 8s, tons of Days Inns. While they have a lot of brands up here, the percentage of total revenue and total room count coming from upscale and above is very small. So it's an area that they're looking at growing. They made an acquisition of Vienna House a few years ago, but I think it was just like 40 or 50 hotels So not a big deal. Waterwalk was one. I think they just announced recently, and I may be wrong, but I think it's literally 10, 15 hotels. So at the end of the day, it's really an economy mid-scale business. They're looking to expand into these things, but you have to be comfortable having exposure to a royalty revenue stream coming from these types of assets. And mostly across the US too, while it's a global company, which we'll look at in a second as well. Doing a bit of an overview here, their pipeline is really huge, which is great to see. I think they have around 900,000 plus rooms in their portfolio today. They're going to be able to add about 200,000 rooms just in the rooms that they are currently working on adding across their portfolio. Lots of those are Echo Suites, which is a new brand that they just started. It's an extended stay brand where people would go to stay a month, 2 months for a bit of a lower, daily room rate potentially than if they were to rent that on a night-to-night basis. And the rooms are typically a bit bigger. You have a kitchen, you have other things like that. So that's been a growth area in terms of demand across the US, and they're kind of trying to fill that need through development. And after they build these with their development partners, and they license them off on 20-year royalty agreements and stuff to operators. Waterwalk is another one that we just talked about that they recently added to their pipeline, and brands, I should probably say. But in addition to this number being pretty big, they continue to grow it. So they're going live with new hotel rooms, but they're also continuing to build that pipeline out for the future. So I think they have a pretty good tailwind long term of just growing their absolute room count. The more rooms they have, every single room is a profit center for them, that every single day they're getting 3, 5, 6% of that daily room rate coming into the Wyndham Hotels and Resorts Corporation. So this is going to be a big driver for them longer term, which is great to see. In terms of their network in the US, they do have operations outside the US, actually pretty big operations if you look at the absolute amount of hotels, but they get the most of their royalty revenue from the US. And that's because some of these other markets they're in, they have other master franchise agreements where they also have a partner in that local market that franchises to the franchisor who gets a slice of the pie. So they're getting a much smaller percent of the revenue, whereas in the US, they franchise directly with lots of these operators. You can see here, really well developed on the East Coast and kind of the Northeast there, less developed on the west side of the country, but they still have pretty good presence coast to coast, I'd say, in the US. They're on lots of highways. Lots of the destinations and hotels that they have are drive-to locations. It's not a lot of business travel, so I guess it's a bit defensive in that sense. But there's really good network, really low capex, super cash flow positive, and they're returning lots of that cash flow to investors. You can see here how much they've been buying back shares even since 2020. You can see here they had 94 million shares in 2020, 91 million in 2021, 85 million in 22, and then this is at the end of 23, 85 million, but in the last quarter, now they have about 82 million shares, and they announced about a $400 million buyback, which if they actually executed would take off another 6-7% of outstanding shares. So we're getting to the mid 70s in terms of millions of shares, down from 94 million just 4 years ago. So they're like serial share buyback in terms of their return to investors. And that's in addition to the 2% dividend that they give. In terms of absolute valuation here, current year expected to do $4.20, which is about a 17 times earnings. Next year, it looks like they're planning on growing that about 10%, which gets them to about 15 times the next year earnings there. So pretty decent valuation when you're considering the multiple of the S&P 500 at large. Obviously, this isn't a tech company or anything like that, but historically, this is a decent valuation for Wyndham, especially with their proven model for returning lots of that money to shareholders through share buybacks, and they also pay a nice little dividend as well. So this is one that I've started buying. I don't have a big position, just 15 shares. Looking forward to building this into a bigger position. Love to get the 25, 50, maybe one day 100 shares of this one. to make it a decent sized position. I'm not looking at this being one of my biggest positions in my overall portfolio across accounts, but I wouldn't mind having some real exposure here, and increasing my share of the company as they buy back shares kind of quarter after quarter. The next one that I've been buying a bit more of is just the S&P 500, especially off the bat, looking at my performance over the last handful of years, being 16, 17%. And the S&P is up like 27% just in the last year. In the last 5 years, up 87%. It's a bit like biting the bullet to buy at these levels, but long term, if you look at the S&P 500, it's not a bad strategy to just buy into that and do nothing else. So I personally like individual stocks and looking at individual stocks, owning individual companies, but my portfolio is developed enough that I feel comfortable starting to maybe continuously nibbling on the S&P 500 as well as just a long-term hold in my account, as the S&P 500 continues to compound over time. With the S&P 500 here, I'm really owning pieces of all these really great companies, definitely skewed to big tech companies just because of their market size. 7% of this is Microsoft, and as I scroll down here, you can get a sense for some of these other companies. Not just big tech though, we have Berkshire in there, Eli Lilly, Broadcom, etc. Just the largest 500 companies that are profitable and get selected in the U.S. market. So pretty small position so far. Just 20 shares, which is about $2,500, under 1% just in this account. But one that I'm looking to build out. Unfortunately, it just keeps going up on me, as you can see here, up 5% in the last month, 7% in the last 3 months. We saw the 1 year before. I wouldn't mind, if the market, took a bit of a pause, gave me an opportunity to get in more. But I'm not going to complain on the S&P going up. It's good in the big picture of things, at least. Another one that I kind of stopped buying in this account, because this is a non-registered account, believe it or not, but I'm buying in one of my registered accounts where I don't have to pay the tax or the withholding tax as a Canadian citizen, is realty income. So I wanted to go into realty income a bit. You can see here in the last year, down about 8%, yielding about 5.6%. And even though they're pretty small dividend increases, they do have a history of increasing the dividend as well. So let's just take a look at their recent performance here. You can see they did over $4, or they're affirming their $4 to $4.20 of EPS for this year, which kind of puts them at $55 a share, around that 14 to 15 times earnings. And, they have a great value creation model. They also have great diversification across their portfolio. They're in all 52 states. They have a big presence in California, Texas. They also have about 10 to 15% of the business in the UK, and they're expanding their Europe division as well, which they're getting really great spreads on. In terms of how they're delivering their total shareholder returns, they're looking at about 10% FFO growth. You can see the dividend yield, you're getting about 6%. Then they're generating organic growth of about 2%. And then this 2 to 3% is around the acquisitions they're making. So as they, take on debt or pass equity off for 5-6%, and then they're getting 8, 9, 10% cap rates on certain stocks, certain assets rather, not stocks. That spread goes to the bottom line, assuming everything else goes well. So they're adding all that together, and they're saying they can get an 8 to 11 total return. And this is real estate, so I think it's relatively low downside in the triple net lease space. They have pretty good tenants going to their tenant mix here: Dollar General, Dollar Tree, 7-Eleven. They own the Wynn outside of Boston as well. They own 20% of the Bellagio in Vegas, CVS, Tesco, BJ's. They have some stuff here like AMC, Red Lobster. That's probably not great stuff. But over the grand scheme of their portfolio, they're pretty well diversified. And I don't think anything foreseeable in the economy is really going to impact all of these sectors at the same time in a way that they won't be able to slowly pivot and recover from. So for the mitigated downside, for the monthly income of 5.6%, the diversification across the US and Europe, that outlook of high single-digit return on investment is just fine with me. So that's kind of one of the reasons why I've been adding more of this one in one of my registered accounts, to get more of that high starting yield, even though they do increase it every year as well. It's pretty modest. I think the last few years it's been a couple percent a year. Longer term, it's been about 4%. I also think with these REITs, all of them, but realty income included, as interest rates go down, the capital appreciation of these will go up very quickly. And I don't want to miss that boat. So I'm kind of getting on it now and adding to these REITs passively on a monthly basis to get that income now, but also hopefully that capital appreciation down the road as well. Meta here. Meta is one that I just wanted to touch on quick. It's been my biggest winner in this account. You can see here it's up 90% in the last year. Overall in this account, though, I'm up about 350%. So not one I'm touching for tax purposes. I put in about, let's see, about $1,000. I'm up about $4,000 on it, which gets me to the $5,000 total position in this account. They recently introduced a dividend, very, very small though, but welcomed, especially as someone who doesn't necessarily want to sell their Meta shares across accounts because of the tax implications. So I'll take the small dividend I'll get on a quarterly basis. Hopefully they grow it over time, but that's definitely been a nice winner in my account here. Continuing to scroll down here, TD is a pretty big position, not just in this account, but some other ones for me. And it's fell under some weakness lately. They recently got tied up in a money laundering scheme or issue that they may have been negligent on not catching early enough. That knocked the stock down from around 80 to the mid 70s. Looks like it's starting to recover here. Now back up to $78 a share. But this is a bank that I really like for the long term. They've kind of been muted on their ability to make acquisitions in the U.S. First Horizon fell through because of political pressures. Also, the regional bank crisis just didn't make as much economic sense. And then now with this money laundering thing, it may put more hurdles and barriers on them making acquisitions in the U.S., which is bad. But hopefully they can slowly grow organically there. They have a really profitable large business in Canada as well, paying a 5.1% dividend yield at these levels here. And it may have been adjusted downwards, but the last time I looked at it, they were expecting just over $8 of EPS this year. So in that range, probably trading around 10 times earnings, paying a 5% dividend yield, really strong history of accretive investments. They also do buybacks. So this is one, along with just the banking sector at large, that I do like in my portfolio. Go into one name here that hasn't been performing very well for me. It is A&W. So A&W Royalty Corporation. This is a company that gets a royalty on every dollar that's spent at A&W restaurants across the country. They've recently increased their store count to over 1,000. So they have about 1,030 restaurants across Canada. Each of them, as soon as they realize revenue, they have to pay the royalty fund. I think it's 4 maybe 5% of their top line revenue. And you can see that this stock has just been downtrending pretty aggressively, down 22% in the last year. You can see it's been a bit choppy, but even before the pandemic, it was in the high 30s. We got back up there to around 40 and then tailed down from there. Historically, A&W has been a fast-growing same-store sales growth company and brand. They've been expanding really quickly in downtown cores, lots of new store counts, stuff like that. Paying a 6.5% dividend at these levels now, though. They used to pay 3-4% in Canada, or a 3-4% dividend, and it get increased, 5-10% a year. Now they're at about 6.5%, and they're still increasing it. They increased it last year, but much smaller increases, and that just directly is a result of the performance. You can see here, year over year, royalty income increased. We're at about 1%, same-store sales growth at about 0.6%. So there's been a huge deceleration of growth. This is no longer viewed as a growth stock where you can buy at a 4% dividend yield, and 3, 4, 5 years from now, that same investment is going to be yielding you 6%. Now it's kind of viewed more of a value stock or just like a cash flow stock where you're getting that 6.5% up front, but it's not necessarily going to compound in terms of how much more growth per unit you're getting over the medium term because these results are coming in relatively weak. And they've also taken a lot of pricing as well, along with the rest of the fast food category. So this 1% or 0.5% increase in sales really probably equates to losses in units or trips anywhere from 5 to 10% would just be my high level guess. I haven't looked at their most recent report other than the top line here. So this whole trend of just less people visiting the restaurants, as well as sales growth slowing down greatly, is just kind of re-rating the stock, like I said, from a growth stock and a reliable growth stock, if I was able to make this chart longer, to more of like a cash flow value stock, similar to how like Pizza trades for today. That royalty fund here, paying a dividend yield of about 6.7%, or Keg Royalty. This one is a bit more vulnerable to consumer discretionary spending, so it has a bit of a higher yield of about 8%. It's playing more in the realm of these stocks here versus a growth play as it used to. So don't love to see the value get diluted, but I'm still getting the same amount of monthly cash flow from this. I'm not really reinvesting it in this company at this stage. I have other priorities that I'm investing in my account, like we just talked about with Wyndham, with Realty Income, with the S&P 500. But I'll keep a close eye on it if it just gets to the point that even as a cash flow play, it's trading at too low of a valuation and the results hold up or maybe start accelerating. It's when I'll consider adding to a bit more in my portfolio. Another one I just wanted to touch on before wrapping up here is these cash ETFs. So this is kind of how I put my cash on the sidelines. I've talked about this before, but they're just high interest savings account. You get about 5% dividend yield throughout the year. How it works is throughout the month, you just accumulate interest, and then at the end of the month, it pays you. The interest it accumulates goes back to $50 a share. So super low risk way of holding cash at about a 5% return. I own it in this ETF here. I also own another high interest ETF just to split up, my exposure to singular ETFs. But I have another one with the ticker. Where is it here? PSA, another high interest savings ETF. So I like these for parking money. Obviously, over the long term, I don't expect it to outperform, but with the market trending up as much as it has, this is just the equivalent of my cash position. So I think I have about 7-8% of this total portfolio in these accounts that are just generating interest on a monthly basis for me to, either put back in that cash account or reinvest in a couple shares of a stock here or there. So that's kind of my update here. Overall, portfolio has been doing pretty well, up about $10,000 in the last month. Over the last 3 months here, about the same. So it's really been the last month that's been driving the portfolio here. Focus areas will remain the same. Want to make sure I continue to have a healthy cash position on the side, but also want to be building that Wyndham position, looking at strategic areas on REITs and interest rate sensitive stocks, as eventually I feel like the pendulum will swing back closer to historical levels of interest rates, and companies like Realty Income will benefit from that. And lastly, just continuing to nibble on the S&P 500. Would love to have that as a big part of this portfolio. Just hard to really dive in a big way with it, ripping how it has in the last year. So hope you guys like this kind of content. Let me know in the comments what you feel about the stocks I talked about today, or what stocks you've been buying recently. If you like this kind of content, be sure to subscribe to the channel, and I'll see you guys in the next one. Thanks.